All right, good morning, everybody. Welcome to the sales meeting. As you know, we're going to do a 1031 exchange this morning, but we want to start first with our partners. Scott, you want to kick things off this morning for me?
Sure, and I'll just stay with the subject that 1031 is a great vehicle for the right clients. And I guess the only thing I really want to say is that it's pretty easy on my end. There's not a whole lot I have to do, especially when I have Lynn involved. And as for most of you heard when I jumped on, that Lynn's the only 1031 exchange person's name I give out. I probably get 15 to 20 a year. People doing 1031 exchanges, and again, I give them Lynn's name only. I don't have any other name in my stable that I use, and she does a great job, and the company does a great job. So that's all I really need to say. I have a closing coming in at 9:30, so I'm going to jump off just before that.
No worries, Scott. We appreciate you coming in. Anybody have any questions for Scott or on the attorney side?
Any interesting legal things coming up in any of your deals that you need to talk about?
So I'm going to reiterate today, please, please, please make sure your clients are using attorneys and get them in earlier than not to make sure that the contracts are done on the right way with any issues being addressed on the front end. You can't be changing contracts after you're under contract. And when it's painful.
I have a deal I just got yesterday where the seller apparently is not using an attorney, and so I asked if I could draft the purchase and sales, and the listing agent replied back, "Is there going to be anything out of the ordinary? Because if so, the seller's going to need to have an attorney look at it." And I said, "Well, it's not out of the ordinary to me, but once they get it from me, they're going to have an attorney take a look at it." Melissa's joining us. Is yours not working?
My computer's not working.
Do you want to say hi?
Hi.
Hi, Melissa.
Anything you want to say? I already kind of went. So.
Yeah.
Do you anything you have for your week?
Yes, actually, very quickly. I saw a very interesting offer this week, and my clients were repeat clients, and they said, we really wanted to be aggressive and hit the ground running. We last bought during COVID. It was super competitive. We lost out on 10 or 15 houses before we got our offer accepted. So they went in and offered use and occupancy, which we see a lot. But one thing that was really interesting, and the sellers actually said, this is what sold it for us. They offered to pay the sellers tax stamps. And in the scheme of things, it's not a huge thing, but it's a couple thousand, few thousand, depending on the purchase price. And the sellers thought that was amazing. And they accepted their offer, and they said the turning point really was offering to pay those taxes for us. So
cool.
For buyers that are out there competing, sometimes the smallest thing makes the biggest difference.
Wouldn't have thought of that one. That's a new one.
Yeah.
Good. All right. Anybody have any questions? Is Andrew on here? I don't see Andrew on. So we will jump right into any questions for our attorney partners today? As always, you know how to reach them. You know how to find them, right? You know how to find them. All right, I want to introduce today's topic is on 1031 exchange, as all of you have heard multiple times. I want to introduce Lynn Bagby, who is a VP over at Asset Preservation, Inc. As you heard Scott mention, 1031s are a very specific type of transaction, and clients will need help navigating that to ensure that they do everything properly. So let's turn the floor over to Lynn so she can go through and tell you all you need to know about 1031 tax deferred exchanges so you can help your clients go through things the right way.
Thank you, Paul. I really appreciate it. So nice to meet everybody. I want to thank Scott and then say hello to Melissa as well. Thank you so much for being part of all of this and getting this together. I do appreciate working with you and your colleagues for multiple years now. So thanks again. The purpose of this presentation is because there's only a couple of ways that a seller of real estate gets any tax advantages. One is the primary residence exclusion. I want you to remember this number at section 121. We're going to address it later. I don't deal with that except in the case, and this is what I'm so excited to bring to you today, of an owner-occupied multifamily property. What do you do with that? Well, guess what? It's got multiple units. If they live in a unit, the other units have been rented out, they get to use both tax codes, potentially, based on what I find out about the other units. which I'll address later. I want to spend a little bit of time on that. I also want to let you know that anything we talk about today, this is just on a slide deck. So if you've printed out the PDF, I'm going to show you areas to make notes, but just also make a note if there's any topic that you want additional information on after the presentation, to go ahead and email me about that topic. I've got 150 topics that I can send some printed material out, and I'm glad to do that. So let's get started. First of all, disclaimer, let me back up. Nothing I say today should be taken as tax or legal advice. You've got your professionals in the law firm of Scott Sellers and Melissa. Melissa, I forgot your last name because I'm thinking about 1031s. What is it, please?
It's Gabriel.
Gabriel, yes. I know, I always have to look at how to spell that one, so thank you. And then you're gonna have, your client should have a CPA that understands real estate transactions. If they don't, I'm sure Scott and Melissa probably have someone that one of their regular clients works with that understands real estate, because some people are just using tax preparers or TurboTax. I can tell you that both tax preparers and TurboTax do not have access to the specific information that's drilled down other than basic stuff. Sometimes those programs don't have a lot of the information needed to determine, is this 1031 exchange good for their client or not? So, or will it work? But anyway, so I'm just giving you like the general information and the overview. I can go into more detail on a call with your client. So again, don't take anything as tax advice. Everybody's transaction is like a snowflake, even if it seems like it isn't. A little bit about me. We're going to skip it to save time. I'd rather talk about 1031. You can go back and look at this later, but just know that I have been in the industry for 25 years. I maintained a certified exchange specialist designation for most of the time. I believe it's over 20 years. I am not one now because I still participate in the Federation of Exchange Accommodators, but nothing's really changed in the tax code. So there's nothing I really need to do to keep it up. So I do work for Asset Preservation, which is a nationally recognized QI firm. We've been in business for 35 years. Our founder is our president. So, and we are a wholly owned subsidiary of Stewart Title, which means that we have great financial backing. They're a 130-year-old title insurance underwriter. So they've been a long time too. They're on the New York Stock Exchange under Cisco, SISCO. So you'll be able to see how big and their financial presence. Here's why you need to know. This industry is not regulated. There are no regulations on the 1031 industry. So it's very important that you know who you're working with, and that your clients know who they're working with. So that's enough about that. This little simple tax code, you'd think, gee, look at this. She should be done in 5 minutes. But there are big, thick books out there written on 1031 exchange. Like I said, I have 150 pieces of printed material about things that pertain to 1031. But this is it, folks. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business, or for investment of such real property, meaning real estate, is exchanged solely for real property of like kind, which is to be held either for productive use in trade or business or for investment. Basically stated, and we're going to go through this in more detail, it's real property. Either been collecting and reporting rental income, whether it's residential, commercial, or mixed use. Mixed use, it would be like driving down Broadway in Everett and you see like a laundromat on the bottom and some apartments on the top. Or if you go through East Boston, Orient Heights, there's Viking Pub. I think it's some other pub now, Renegade Pub, I think. And it's got some apartments on the top. I live in Winthrop, so I see it every day when I drive out of there. That would be mixed use, or a property that you're running a business out of, okay? Or raw, unimproved land, keyword unimproved, okay? Once you change the nature, character, or use of the property, it may no longer be considered as investment. So again, that's really what it's about. You're getting out of one type of property that you no longer want for whatever reason, and you're exchanging into another type of property that meets the investment criteria. And if all the facts and circumstances are favorable, you may be able to defer those capital gains taxes either in full or partially. And we're going to go through some of that math quickly in a little bit. This tax code was codified in 1921. Real quick piece of information. First federal tax bills came out in 1913. We were going from an an agricultural area. Nobody knows that better than the state of Massachusetts. We're going from an agricultural nation to an industrial nation. And by 1918, property taxes were extremely high. If you drive around Massachusetts, you can probably see that farmland had been in families' ownership since the 1600s. How many years is that, folks? It's a lot. And they did not want to sell that farmland to the industrialists or the railroad that was coming through. Government stepped in and in 1918 allowed the first property swap. So up from 1921, when it was codified, it was called 112K. Up to 1979, it was actually just a swap. People were swapping properties. Changes in the tax code from 1979 to present is you're selling property and buying property. Do people still do swaps today? Yes, but very, very rarely. They can be a little difficult, but at any rate, so that's where it is. You're selling and you're buying and you have an exchange period, which we're going to go through in order to do that. This allows taxpayers, again, to either defer the capital gain and taxes due into other investment property, either in full or partial. This is a great wealth building strategy. This is how you can build generational wealth. You can maintain your wealth or build your wealth when you use Section 1031. Again, there's only 2 tax codes that give you those tax benefits. One is primary residence, one is 1031 for tax deferral on investment property. Here's a quick look at long-term capital gains taxation. People call me all the time, Scott, Melissa, I'm sure they say the same thing to you. Well, gee, if I sell, don't I have to pay 15%? Or don't I just have to pay 20? No. Here it is. Here's a side note here. Depreciation recapture tax at 25%. If your client is selling residential real estate, it depreciates at 27.5 years. So it's not as simple as dividing their original purchase price by 27.5 because land is not able to be depreciated. So their CPA, I'm giving you a little bit more than you need to know, but some of you may have real estate. I don't know that there's an actual percentage when a CPA sees that somebody bought a property originally for $400,000. When they send me their sheets, which I can't give advice on because I'm not allowed to give tax or legal advice, I see that they do take a value off for the land, but I've been playing with a couple things and I can't get a percentage. So I don't know if they say, is it like 20% of a property's original purchase price or 25 or 10? I don't know that. So I have to look at each thing like a snowflake. So they've taken off a value of the land and they're depreciating the building. Okay. And then as capital improvements are added, then those are depreciated too. So just know that whatever depreciation they've taken gets taxed on a sale, whether they've owned it 3 years, 5 years, 10 years, 20 years, at a rate of 25%. And that's a flat tax rate, okay? Federal capital gains tax, depending on the tax bracket you're in. So for 2025, if you're a single filer, if you're greater than $533,400, then you are in the 20% tax bracket. If you're married filing jointly, you're in the $600,050. Is that $600,050 where they come up with these numbers? I don't know. If it's greater than that, you're in the 20. Everybody else is below that. However, there is a threshold, and you can go online and find it, that if you only make a certain amount of money as a single filer or married filing jointly, you may not be liable for capital gains taxes. So people need to check with their accountant about that. It's not my call to make. These are just the thresholds here. And then you have the net investment income tax, which is part of the Affordable Care Act, which we still have. So in any passive income, which includes the capital gain from a sale of real estate, okay? That capital gain, rental income collected, stocks, bonds, or notes sold, insurance money collected, anything you did not earn a 1099 or a W-2 paycheck for would fit into this category. That tax is 3.8. Then you have the applicable state tax rate. In Massachusetts, it's 5%. So cobble them all together and you're in the 15% tax bracket, you have a decent amount of depreciation. You may be paying 28.8% of your capital gain in taxes, up to maybe 32% if you're in the 20% tax bracket, okay? So that's, now it seems like maybe I want to talk about a 1031 exchange. Do you guys have a question or are you leaving? Scott, Melissa, did you have a question?
No, guys, we gotta run because I have a closing coming in.
Yeah.
So
Thank you.
take
Appreciate
care,
it.
everybody.
You.
Hope everything goes well. Basically, when when your client is contemplating a 1031 exchange, they can either call their CPA first. Again, if they have a tax preparer, I don't know if they're going to get the best tax advice, but call their CPA. Depending on the QI you're working with, I like it when people call me around the same time, because one of the things I will do is I'm going to look at their situation and specifically give them questions to ask their accountant. I'm not here to take their deal like a pizza order. I'm not. I don't think it's fair. I guess the reason I love this industry, I got into it because some really bad financial decisions I make, getting sold on something, or somebody told me to go do something and I did it and it did not work out well for me. So I just would really like to take a look at the situation, give them the questions, and I make it so it's forwardable. They can forward them to their CPA, and I'll give supportive attachments, part of the 150, to support my questions. And then they lots of times they'll get back to me, they'll advise their clients accordingly, what have you. So just keep that in mind, because some CPAs they're willing to learn, but they may not have a lot of experience with 1031 exchanges. So I think in tandem, if they call both of us, then we can get that conversation going to see if this is a good alternative, a good option for their clients. Okay, here's what doesn't qualify. Remember, I said it's real property, real estate that you've been collecting and reporting rental income, or running a business out of it, or holding for appreciation like a chunk of dirt that you don't do anything to. But here's what does not qualify. Stock and trade or other property held primarily for sale. So what is that? Property flippers does not qualify. What's their intent? Buy, fix, sell. Developers, buy, build, sell. Those are taxable sales. Where is the held for investment piece? It doesn't make a difference if it's taken them a year, 2 years, 5 years to rehab or develop a property. Property held for sale. What's the intent? Buy, build, sell, buy, fix, sell. Doesn't qualify. Now, if they were to buy, fix, rent for a period of time, potentially, or buy, build, rent, again, potentially. So there we go. Stocks, bonds, or notes. Make a note. A REIT, R-E-I-T, is a stock. Even though the REIT owns real estate, you cannot sell investment property and buy into a REIT. There's a way to get there, but not right away. It's by purchasing into a Delaware statutory trust. It's commercial. I have contacts for all of that, which eventually trades. A REIT company will come in and buy and offer OP shares. People can get there, but you cannot directly sell and buy into a REIT because it's a stock. Bonds or note sales, also taxable, doesn't qualify under 1031. Selling an investment property and paying off a mortgage on another property, whether it's their primary or other investment property, does not qualify. Interest in a partnership. So if Jack, I'm going to pick on you because I can see your name. So thank you. Jack wants to sell a property and he wants to buy a property with Paula, and there's a woman behind me. I can't see her, but let me just, you know what? I know Matthew from your office. I'm going to just say it's Jack. Jack wants to sell a property and buy into an LLC that Paula and Matthew own together. You cannot sell a property and buy into an LLC that owns a property, because the LLC is a regarded business entity. It has 2 people, and you cannot, and the entity owns the property, not the people. So you cannot do that. They would be able to sell Jack a piece of that property, and Jack could be a tenant in common with them for a period of time, and then they could do something later, but you cannot directly go into buying into a business entity that owns a property. Certificates of trust or beneficial interest. There's the same things with a trust. If a trust is the taxpayer, you cannot sell and buy into a trust. And then a chosen action, which is an award to a lawsuit. If you get a big chunk of money in a hit and run or something, and they catch the person that ran, and you sue them and you get a big insurance check, that's not exchangeable, or any type of a lawsuit. What real properties excluded? Your primary residence, and again, dealer property or flipped property. And I want to jump down to this one. The definition can be broad. So commercial, single family rentals, multifamily, office, industrial, easements, like a cell phone tower easement, air rights and water rights. I did a deal in New York City where the client had owned a building for 5 years. He sold the air rights above it for $300,000 and bought a $750,000 multifamily in Jamaica Plain. Perfectly doable. He had owned that property underneath it for 5 years. So, and he still retains ownership. He sold his air rights. Qualifying vacation home rentals. I've got a whole slide on it, but I would like anybody that's interested because they have a property, somebody they know, they've got a client that they're selling a home for, but they're asking them about this property at the Cape that they want to sell. Let's talk about qualifying vacation home guidance, see if it might qualify under section 1031. Let's see, what else do we have? Fractional ownership interests, which are a DST, and leasehold interest of 30 years or more. So this is quite extensive, and a lot of people don't know what they can exchange into. This is where it's really important to have a conversation with the qualified intermediary to tell them what their options are if they're not sure. It will help you with a listing if you can introduce somebody with investment property to a QI, they can get them to understand it, talk about their advantages. Scott may be able to help as well as far as some of the legal things and also their CPA, but this may help you get that listing over other agents that aren't even talking about this or making the suggestion. Please know that as an agent or a broker, it is not your job to advise people about whether they should or shouldn't do a 1031. Believe it or not, it sounds like I give tax and legal advice, but I don't. Every information I give you is from the tax code or something that I've seen clients do that they should ask about. So yours would be, you may qualify. So you may want to have this conversation because it's investment property and just hand it off. But again, if you even bring it up, I've gotten so many agents that have told me they've gotten listings because they talked about this. So, and a sale too. Here's the information on vacation home guidance. So for 24 months prior, and the reason I want you to know about this, you may have people that want to sell in your area and invest into something at the Cape, in the mountains in New Hampshire, the beaches in Maine. I mean, New England is full of vacation area rentals. So prior to selling a qualifying vacation property or purchasing it as replacement property, you have a 24-month period either before or after, and it's divided into 2 12-month periods. The property is either available for rent or it's rented. It's available for rent or it's rented. rented, available. Now, you do get some personal use time. So you have to, you get 14 days, each of those 2 12-month periods. So let me give you an example. Say for the first 12-month period, you have 30 days of reported rental income. You get to use it 14. Second 12-month period, you've got 180 days of rental income. You're going to get 18. You automatically get 14, bless you, Paula. You automatically get 14 up to 140 days, any amount, as long as you're declaring that rental income for a minimum of 14 days. And it doesn't have to be sequential. It can be 7 weekends, whatever. It's available the rest of the time. But once you reach 150 days, you get 10%. So you get 15 days. At 180, you get 180. I've got a lady in Newport, Rhode Island, who rents to a professor at Salve Regina, and she rents it 300 days a year from her and then goes home to visit her family for the summer. So that woman gets to use it herself personally for 30 days, which is not a bad gig, right? Who wouldn't want to stay down in Newport for a month in the summer? And then after that 24-month period is up, so I'm looking for that if they're selling one and they're going to buy something different or another vacation property. I'm looking as a QI at that 24 months prior to sale. If I have any questions, I'm listing my questions, having them. They're asked to see their CPA and providing our vacation home guidance template. On the backside, if your client is going to be buying in that area, I'm having this conversation with them and providing this template for them to discuss with their CPA. Please note, the IRS only tolerates your family. So if you're renting to a family member, it has to be as their primary residence at a fair market rent. And then you can get on and stay with them, right? I didn't say that. But anyway, that you know, again, you're renting and you're reporting the rent as rental income as a fair market rent. So if you were just renting to them for a vacation or something like that, it's viewed as your time. So you have to be very careful with this. Questions people ask me is, how does the IRS know? Well, they may look at electric bills. They may look at your rental time versus your non-reported rental time. They may ask for cell phone tower. They may look at your cell phone tower pings if they're really serious. I had somebody tell me that. Also, restaurant receipts in the area at the time where you're saying it's not rented, but yet you've been in the area and you live in St. Malden, right? So I'm not the IRS police. I don't know about it. This is a conversation between a client and their CPA, but people are always asking me, well, what if I do this? What if I do that? That's a conversation for their accountant. That's your answer as well. So this can be confusing. I'm glad to have offline conversations with anybody that wants to talk more about it. Okay, now, when I say that the property must be held for productive use in trade or business or for investment, how would the IRS know? Well, there's a couple of cases out there. Some of it is intent. There is no actual holding requirements under Section 1031, but one of the periods is, I just told you about a 24-month hold. Please note that there are calendar years and tax years. A calendar year are 12-month periods. Tax years is every time we change a tax cycle. So going back to the vacation home guidance, unless you're looking at January 1st of 2025 to December 31st of 2025, and then we go from 2026, around, that's two 12-month periods. It's also two tax years. However, what happens if somebody starts the cycle in October of 2025? If you go around two 12-month periods, it's 3 tax years. So when people say, how long do I need to hold a property? Well, guess what? You can take a long-term capital gain in 12 months' time, depending on the kind of property. We've just seen in vacation home guidance, you've got a mandatory holding period to be able to call an investment. So again, 12 months' time, you can take a long-term capital gain. That may be reported rental income activity on showing that the property is investment. 2 years is a little bit more conservative, a little bit more, it's not as aggressive. And then the IRS, if you're ever audited, asks you for 3 years worth of tax returns. So if you get to that 3 years and 3 years and a day, you're in a 4 tax year period. Depending on if you're going to exchange throughout the course of your life and then target a property that you're going to eventually move into, maybe you're holding it for that 3-year period, 3 years and a day. Not my call to make. So the IRS, when in an audit, and just a little bit about audits, I'm giving you probably more information than you know, but some of you may have investment real estate, which is why I wouldn't take this time to tell you. You only get audited if you're reporting under your social. It's a random audit. When you report a 1031 exchange, it's on a like-kind exchange form called the 8824 form, which is an attachment to your regular 1040. So if you just get picked up in a random audit and they were to see that there's a year in there that you have an 8824 form attached, that's when they take a look at it. So, and then they may ask you for other years too, but it doesn't make you any more susceptible to audit than anybody else. The other time they have a holding period is in, no, this is not the one I wanted to talk about. Selling and buying property. Side note here, it's the tax ownership that is the most important, okay? The tax deferral is on the tax owner of the property. So when I'm looking at a transaction, and sometimes I have to call in, and Scott and Melissa on this is to help me find out who my tax owner is, along with their accountant. Here's general information. First of all, we live in a non-community property state, so legally married spouses are viewed as separate tax owners, even if they're married, even if they're filing as husband and wife, spouse and spouse, married filing jointly, okay? So if the wife is selling, the wife is inquiring. If an LLC sells, the LLC acquires. Make a side note here. I'm assuming that this is a multi-member LLC. Okay, so it's a regarded business entity for tax purposes. So this would be a multi-member LLC. Make a note. So I'm going to tell you something that's going to contradict me otherwise in a minute. A corporation sells, a corporation acquires. Why? The tax ownership must pay the same. Who is the underlying taxpayer for the title holder? That's my key question. Who's the underlying taxpayer for this title holder? Who is filing a tax form and what number is being used? Okay. A partnership sells, a partnership acquires. But this is just a guideline because in non-community property states like we are, again, legally married spouses are viewed as individual tax owners. So if one spouse is on the deed, that's who's selling, that's who's buying. All right. But what you can do, Jack, because I can see your name, I'm picking on you again, my friend, until somebody else pops up, you're it. Let's just say Jack is selling a property he owns in his name. Now, he just had a single family rental. He's been renting out to the same tenant for a bunch of years, but now he wants to buy a multi-family, whether it's a 2 to 4 or it's more commercial where it's, 5 units plus. That's what he wants to do. Well, he may be advised to buy it in a single member LLC. Remember, he can't add other people to it because it changes the tax ownership. With more than one member, it becomes multiple members. It's going to change the tax ownership. But he's going to own this himself. And he's advised because the bank, because it's a 5-unit property, wants him to take a mortgage in the name of an LLC. So he can form a single member LLC. Because guess what? He is not going to take the corporate tax election. That would be a Schedule C. He would take the individual tax election, which means it's going, his Social Security 1040 and a Schedule E will be the number he uses in the tax filing form. So that's okay to do, because what did not change? His tax ownership. So here's a situation where he's sold in his name, and we know the tax ownership, which is his Social 1040 and a Schedule E, needs to stay the same. But when he's buying, the bank is saying, because we want you to have limited liability protection, this is a commercial property, we want it in an LLC. That will be fine, because at the end of the day, he's going to take the individual tax election. His tax ownership stays the same. That's what the IRS needs to see. There's no change to tax ownership. This is why it's very important to have appropriate professionals around you when you're thinking about doing things. I'm going to take a minute now and say this is one of the things that can really mess people up. You may be working with a husband and wife or spouse and spouse, and because they're married, they're buying property that's either really expensive or they need to take a commercial loan, and a bank is going to say, you need to put this in an LLC for us to give you a loan. I have this happen many times. For them to go into an LLC together makes it what? Jack, I'm picking on you. A partnership. It makes it a partnership. It's two people. Just because they're married, it doesn't make a difference. So therefore, what can they do? They can, each spouse would make their own LLC, and lenders will accept that. At least the ones that all my clients have been working with. So because you've got each spouse in their own LLC, they'll then issue the loan. Okay. And so that's how that would be done. So at any rate, these are things that, so when Scott was saying, and Paula was saying, get an attorney right away when your client is, taking offers or whatever, get them in the mix early. If I see that it's a 1031 exchange, they need, this needs to be, I like to know when people are even thinking about it, because I'm looking for red flags. Not all QIs do. Some do take it like a pizza order. I want to get, let's see if we can clean up any mess that might be there ahead of time. Definitely, I'd like to know when people are listing. I like to know when they accept an offer, but I need to get involved and start doing my work to get documents put together when they accept an offer. Okay, so that's kind of how I like to work. But I can save a deal 2 days before closing, the day before, by getting docs out, but it doesn't give us that time to work. So again, more time is better. Okay, we're going to skip all the, I'm going to let you see this slide quickly. We're just going to go down. We're going to talk from the simultaneous down. Can we do a same day closing? Yes, if they're selling the same day that they're buying. We would have been talking about this ahead of time. They sell first, buy after. We're going to have special documents for this. Can we do it? Yes. Not always ideal, because guess what could happen? If that buyer, there's a hiccup, and now the buyer can't close till a couple of days later, and you've got a seller that's not willing to wait to sell the replacement property, that can be an issue. So let's talk about these, but can we do them? Yes. The delayed exchange with a qualified intermediary is selling first, and then you have an extended period of time to close. Most common. I'm not going to spend any time on reverse improvement or reverse improvement exchanges today. I just want you to know about them. I will tell you they have a longer setup time. You can buy first, then sell, but you need to have a QI involved early on, and people have to have the money to buy the property in hand, or they need to be able to find a willing lender, and traditional lenders, regional lenders, and national lenders won't lend. You need a local community bank or savings and loan association. So if you get a client talk about, I found a property I want to buy, but I haven't sold mine yet, there may be a way to still do the delayed exchange and get a same day closing out of it, where they sell first, then buy. I'm going to look at other options before we go this route. Improvement exchange allow you to buy something for less than value and do capital improvements. that I want to talk about that one. And then reverse improvement, we're going to hold park title we're going to take the title to the property they're buying with their money to buy it. And if it's lesser in value than what they're selling, they can have improvements done. These are offline conversations because I'm not teaching a 3-hour CE class or 2 hours. Okay. Just wanted you to know about them. So let's talk about the delayed. First of all, there's language that can go into the contract, that can go in around the signing of the P&S contract. It's not fatal if it's not there on the sales side, but it definitely needs to appear when your client is buying, because it's what makes the purchase contracts on the replacement property side work. The seller has control of the P&S on the sales side, but they don't when they're buying. So to make our documents work, it needs to be in there on the buy side. Okay, so those are just samples of them, which you can copy and paste this. Many tax professionals do like to see it on the sales side too. So I supply it to the attorneys. Let me tell you one more thing. As an agent, when you're listing a property, 1031 is a tax election on a real estate transaction. It is not the real estate transaction. So it does not need to go in listings. It does not need to go in at the time of offers, either on the sale side or the buy side. You don't even need to talk about it. When your client's trying to buy a replacement property, it's all about a purchase date, negotiations on the condition of the property, and a price. The 1031 exchange in the delayed format will work when the sale closes first and they're able to purchase after. So think about it like when somebody's selling a house or buying a house. If you're listing a property for somebody, right, fine. They're going to sell the property, but when they're going to buy something and you're dealing with, I'm telling you this now because you might have clients working with another QI. I just want to give you this information in general. But on the buy side, it's not necessarily to talk about it at the negotiation stage. You're just trying to get this property to close, just like you are a house. When someone's selling a house and buying a house, you're getting the property they want to buy to close after their sale closes. The 1031 exchange delayed format will work when that happens. Okay, so let's take a look at the next slide. And you're animated. Let me just go to the final one. I'm going to talk from this. So again, I already talked about a lot of the things you're going to do up front. You're going to have if the client's going to list a property, you see that it's investment, they're considering a 10th, they may qualify, they want to talk to somebody, we're having that conversation. We've walked through the process. They have decided they want to move forward. They're letting me know when the property's got an or you and me know that they're letting the property's got an accepted offer. And now we're going to start moving forward when the P&S is being drawn. There's documents. I'm going to call Scott and Melissa and say, hey, listen, I need a copy of the signed contract. I need a copy of the current deed. Who's the closer? Confirm the closing date. They give me that info. I review it to make sure I don't see any issues. If there are, we work on that. And then we, as a QI, when I say we or I mean the qualified intermediary, ends up making 1031 exchange documents that'll be signed prior to closing. Clients can sign electronically. I have them in Turkey. I have them in Egypt. I have them in China. I have them Switzerland and Germany right now. So all over the place, plus the United States, because they are US citizens, but they're working abroad. So the point being is they just need to sign them before closing. So once the documents are and that can happen the day of the closing, as long as it's before the closing occurs. They're signing the documents, the sale takes place, their exchange timeline starts from the day they close their sale. If you look at the bottom of the slide, there's 180 calendar days to close to close on replacement property that they're going to identify with this in this 45 days. So it's not 45 plus 180. The 45 is part of the 180. So again, say they close April 1st. They're going to have 180 calendar days to close the replacement property. The first 45 days, April's a 30-month thing. So we're going to look at May 15th as their 45th day. Post-closing, within 24 to 48 business hours, and you can't see me pointing at this slide deck, but I am sorry. Post-closing, they're going to get within 24 to 48 business hours based on whether it's a Friday closing or it's a late in the day closing. Depends on when we receive the funds. Okay, we're going to open up their exchange account. They're going to receive an acknowledgement of receipt of funds. They can use that if you need that because you're helping them find replacement property. If they need to show that as proof of funds to a seller, they can do that. So there's their acknowledgement of receipt of funds. They're also going to get their identification notice, which we're going to look at in a minute. Which by day 45, hopefully you've got them under agreement on something. Here's why. It's not a requirement, but the identification rules are strict. This is where the sharks are in the water. Remember, this is a tax election. They are playing survivor for who's going to get to use those tax dollars. The IRS, they get them because they have a failed exchange, or your client who is engaging in a 1031 exchange, attempting to maintain or build their wealth in real estate and use that 28.8% of the tax, use those dollars to help them maintain or build their wealth in real estate. So ideally they're coming in under contract, but it's not a requirement. You're going to see why it's better if they have one in just a minute. So they're coming in under agreement. They have the remainder of 180 days to sell. Now, side note, 2 things to keep in mind. If they get to day 45 and they don't see anything they like, they don't want to take any other options, they can choose not to send in the notice. The exchange automatically fails day 46, day 46 or the next business day after their 45th day. They give us a call. There's a form they fill out. We'll return their remaining exchange proceeds. Okay. So, and they're paying their taxes in 2026. However, if they go, this property's coming on the market, I might have a shot at it, I've got a couple offers out, and they go, you know what, I'm going to just send these properties in. If they identify property that they cannot close on, the IRS doesn't care. We have to hold their money the full 180-day period. They give us a call that next business day after. There's a form they fill out, and they still pay their taxes in 2026. There's no additions, there's no substitutions, and there's no changing an ID notice after we have it. All right. So that's why I'm saying under agreement. But let me help you. Think for a minute the mindset you have when you have a client that is selling their primary residence to buy a primary residence. What is it that they're looking to do? They're looking to have something lined up to buy, and it's because the moving van. In this case, you've got a 45-day period, a little longer moving van, right? It's not a primary, it's an investment property, but they have 45 days to try to lock something in so they can close within the next 180. So can you help them look for property before their sale closes? Is that an ID? No. What it is you helping them negotiate a contract to get a seller to allow them to close their sale and then close that property. Okay. It's not subject to a 1031 exchange. It's subject to them getting their property sold and closed. When's a good time to start that? Well, if it's a cash buyer, no big deal. Short of the person getting hit by a bus, sadly, and not being able to complete the sale to them, that's horrible. It's traumatic. But that would really be your only issue, because many cash buyers are waiving inspections, they're waiving stuff, they just want that property. However, if their buyer has a mortgage, maybe you're waiting till all the mortgage contingencies have been met. The bank's going to lend them the money. The title report's clear. That the inspection's good and the appraisal's good. Okay, so that might be a good time. Not advice, but just something to think about. All right, because what you don't want to have happen is have them being, they have to buy something because they committed to it, and their buyer falls out of the deal. Okay, so again, not advising, but you guys are agents. You know what makes deals fall apart. I hear about it on the back end. All right, so here are the property rules. Again, your goal in a 1031 exchange for a full tax deferral, and we're going to have a slide in a minute. Paula, let me know when I have like 5 or 10 minutes left, because I want to I want to be respectful of everybody's time, but there is a couple more important things, mostly this, and then also if I fast forward to split treatment. What?
That's where we're at, about 10 minutes. So
okay, good. I think I can wrap it up. All right, so you've got different property rules. Just ignore, in your world, ignore the 95% rule. It's really hard to do. It's like it's really hard to do. And there's been some failed exchanges. Not too many choose that one. So anyway, under the 3 property rule, and we're going to look at an ID notice in a minute. You know what? So you're able to identify up to 3 properties of any value at all, with the intention to buy 1, 2, or all 3. So let me give you a math issue real quick, because we're going to talk about how the money works. Let's just say I'm going to use a big number because I know the math in this one. Let's just say someone sells a multifamily for $1,065,000. $65,000 are what they would represent the allowable costs of sale. What are allowable costs of sale? There's a slide coming up. Your real estate commission, tax stamps, recording fees, and Melissa was talking about tax stamps. Don't have your seller, if it's a 1031 exchange, offer to pay those tax stamps. It's the seller's allowable cost of sale, not giving credit to a buyer. That could be taxable for them. Try to get it some other way. Also paying buyers closing costs, lower the sales price. Okay, we'll get there in a minute. Anyway, the net sales price is real estate commission, tax stamps, recording fee, attorney's fee, qualified intermediary fee. You get to take that off of the full contract price. So that takes you to a net sales price. In this case, it would be $1 million. So the goal to maintain your wealth is to buy property or properties that hit the $1 million mark for a full deferral. That's the equal to number. So many people will do that by buying either 1, 2, or 3 properties. So they would identify them, ideally having signed purchase contracts for them by day 45. However, some people might be buying a portfolio or something that has multiple properties in there, or they could be buying a DST property, which is an institutional grade property that is a fractional ownership, that it's managed by a professional company. It's sold as what they call a Delaware statutory trust, and those deals can have multiple properties. Or they want to go to a really inexpensive area. Like if you're selling $1 million net $1 million property around here, you could still go out to some areas in Springfield and pick up a multifamily for $250,000. I don't know the condition it's in, but they're still out there, which might allow you to buy 4 of them mixed up with those prices. So if you want to identify 4 or more properties, then you need to use this rule. That means if you're selling for $1,065,000, you take the full contract price, multiply it by 2, you're allowed to buy up to that. You're allowed to identify up to that value. You don't have to buy all of it. You just want to satisfy your exchange. Okay. So, again, you'd be talking to me about that. So will your client. Again, this is just the overview. So I'm going to just skip to the notice. This is the notice that we send out. It will, you'll see where you put in the property address. Remember, if they're buying a condo or they're buying something that has a parcel number, if it's a chunk of dirt, that you're listing it on this address, street number, street name, city and state. If there's a unit number, you can't just put 2-bedroom condo at Volusia Estates condominium complex in wherever city and state that is. It needs to be the specific unit number. Sometimes, now I've got Jack and Paula as my clients. Jack wants to sell his property. His net sales price is $500,000, which means he probably sold around 540, okay? Or 535. Paula, he has a property. He's found a property that's $1 million, but he doesn't want to buy it on his own. He just can't get all the financing for it. So Paula says, hey, I'd like to invest with you. Now, we know what they can't do is put it in an LLC, but they can buy as tenants in common, and Paula can contribute some cash and go on the mortgage with Jack if he needs to take a mortgage for the difference because he only has some money from his exchange. And they could both buy that property together as tenants in common. I'm going to have you talk to Scott about a tenant common arrangement. I'm going to have you talk to your respective CPAs, et cetera. But can you do it? Yes. In this case, they're going to buy it 50-50. It doesn't have to be 50-50. It can be 60-40. If Jack has $600,000 and it's $1 million property and Paula just wants to contribute cash and the remaining $400, the remainder of the $400 mortgage. So you can do that too. Each of them will report their respective percentages of income and expenses on their tax returns. All right, there we go. But in this case, because Jack's not buying the whole property, he'd do the street number, street name, city, and state if there's a unit number, and put in his fractionalized percentage of ownership. Okay, so that's what that's for. It's also when you're buying those fractionalized Delaware statutory properties, you do that too. You only need to put a value if you're identifying 4 or more properties. You don't need to do it under the 3 property rule. Sign it, date it. We do not need wet signatures. We can work off fax pages and side scanned email. Okay. Needs to be into the QI by day 45. If the 45th day is on a Friday night, Saturday, Sunday, Monday, holiday, Thursday, whatever it is, get it in around noon, 1 o'clock on the day that it's due. That's a weekday, or the Friday before a Saturday, Sunday, or Monday holiday, because QI offices close at 5. Nobody's there. If you leave off your condo number and you get it in Friday night, because your due date was Saturday, then, or it's Friday, then we're not going to pick it up till Monday or the Tuesday after a holiday. And if there's no unit number, it's as if you're buying the whole building. So there may not be a workaround on that. Here's a list of the allowable costs of sale, which I already talked about. These are, you're able to use sale proceeds for them. So on the sales side, real estate commission, tax stamps, recording fee, and attorney fee and the QI fee are allowable costs of sale. On the buy side, it would be the settlement charges from the closing attorney and an owner's title policy. Because the non-allowable costs of sale that you see on a settlement statement, if you use sale proceeds to pay for them, they can have a taxable component. The biggest thing here might be property taxes. Like the taxes, paying the buyer's closing costs, and things like prorated rents and security deposits. Those can be handled separately outside of closing. If there's a hassle from a buyer's lender that they want to see those on the settlement statement, talk to Scott, talk to the client's CPA, and see if it's fine if the seller brings in the cash to substitute for that. Because if it's deducted from sale proceeds, it's a taxable event for that client. So if you add up a bunch of these, it could be a lot of a tax hit that they really don't want. Not your job, but just want to let you know. All right, real quick, exchange equation. Here's some examples. All I want to say about this one, here's an example. We're selling for somebody selling for $900,000. They have a $300,000 mortgage. Cost of sale is $60,000. So they've got cash of $540,000. If they're buying a $1.2 million property, that whole $540,000 goes in and they bring in an additional mortgage totaling $660,000. That's a full deferral. So you're putting in all your cash, making up the difference with new mortgage money. But I want to talk about a partial exchange real quick. If you have a client coming in they sell for $900,000 and they're buying for $700,000, and this is the only property they want to buy, then I am going to say, find out if they've only owned this property a year. I want to say to them, find out what your tax cost basis is on this property from your CPA. Because if you buy at or below the tax cost basis, there's no gain to defer. You're not going to find this anywhere in writing, folks. So in this example on this slide, if you assume a tax cost basis of like $675,000 or $700,000 or $725,000 because they just bought it a year and a half ago, there's no gain to defer on this sale. They have to exceed the tax cost basis. In this example, let's just say it's $500,000. They sold for $9,000. They're buying for $7,000, but the tax cost basis is $5,000. They would defer taxes on the difference between the $500,000 and the $700,000. Okay, so they have a deferral of $200,000, and then they're going to pay taxes on $140,000. Okay,
For
so
1031 purposes, do you look at the debt? Like
No.
say, no, it's all
Okay,
tax
we don't.
basis.
yeah, it's tax cost basis to net sales price. Make a side note. So when you're trying to determine, again, full contract price minus allowable cost of sale equal net sales price. For a full deferral, you're buying at the net sales price. If you're buying less than, you're going to take your tax cost basis, also known as book value. You need to exceed that number. So above the tax cost basis, you'll defer capital gain between the new sale purchase price and the tax cost basis. You'll defer gain between the new purchase price and the net sales price. Buying at or below that tax cost basis, or just there's no gain to defer.
And on the new purchase, though, it's just on the cash.
No, it's on the number, because what's left? Okay, let's do this one more time. Looking at the equation,
Mhm.
if you take the 900 and you take out the $60,000 for allowable cost of sale, that net sales price is $840. You need to buy at the $840. What's left after the allowable costs? Remaining cash and mortgage balance to make up. So $540 plus $300 is $840. That's how much the IRS says this property, that's where the tax is going to come in. That's the net sales price. So I need to know the tax cost base. If it's $700,000, $675, or at 725, there's no gain to confer. I have a guy right now.
So 840 minus 700, that's the 140.
Yeah. And it's a combination of cash and mortgage debt. It's all about value. You can defer the capital gain on the sale of your investment property when you buy it at equal or greater value than you sold. What's the value? The value is the net sales price. What's it made of? Remaining cash after the allowable costs are paid and the value of the mortgage debt. So when you buy new property, you're buying at 840 for a full deferral. If you buy less than, I want to know the tax cost basis, just to see how much gain you have. You defer taxes on that amount. If you've exceeded the gain with the new purchase price, you'll defer taxes on that number, and you'll pay taxes on the difference between your new purchase price and the net sales price. If you want to have offline conversations about this further, because I've got to get to this next slide, it's so important. I'm skipping through this. Let's just go to this. Owner occupied multifamily. Let's just say net sales price is $1 million. Net sales price is $1 million because it's math I could do in my head. And properties have been rented out to non-family members. You've been collecting rent. You're not letting anybody live there for free or for really like $200 a month, or you're paying your mortgage with their rent and not reporting their payment to you. Okay, that's family. Okay, so this is like rental property. So selling for $1,065,000, net sales price is $1 million. Let's just say all 4 units are the same size. They don't have to be. Let's just say they are. Makes it more difficult when they're not. That means each unit is worth $250,000. So you're going to be able to take primary residence exclusion. If you qualify, you've lived there 24 months out of 60. You can take your primary residence exclusion on the principal unit. Now it's only worth $250, so you don't automatically get $250 if you're single, $500 if you're married filing jointly. It's whatever the gain is. Okay. Now each of these units are worth $250, so that's $750,000. I'm going to make this easy. Client decides they want another owner occupied property. So a full tax deferral, the rental portion on the new owner occupied they buy has got to be worth $750,000. So if it's not a 50-50 split, like if you go to Cambridge and buy a duplex side by side, they're each worth $750. That would be great, right? So it's not 3 units versus 1 unit, it's $750 versus $750. So they would have a full exchange. They're going to live in 1 unit and they're going to rent out the other unit. So they've satisfied the exchange, even though it's just 1 unit. Or let's just say it's a different split. Or they're going to have an owner occupied, I don't care how many units, as long as the rental portion equals $750,000, there's fine. Or they could go buy a non-owner occupied property somewhere for $750,000. Now, suppose there's mortgage on this. Let's just say there's a $400,000 mortgage. You can't put all the mortgage on the investment units and none on the primary, so you get more cash. It would have to be divided up. Okay. So if there was a $400,000 mortgage, so each property is $250, you've got $150 cash on each side. So you've got what do you have? You've got $100,000 mortgage and each unit's worth $250. You've got $150 in cash on each unit and $100 in cash on each unit. In mortgage money, I'm sorry. Principal has $100 mortgage and $150 in cash too. So just keep in mind that this is not your job to work out the details. I will do that in conjunction with their CPA and tax advice, their CPA and the accountant. And then last but not least, here's some highlights you can look at later. I already addressed them throughout the presentation. Can people eventually move into their property someday? Yes. Here's just some other notes you can see. Yes, they can. Talk to me about that offline. I've got a great piece I would love for you to all to email me for. It's called Primary Residence and 1031 Exchanges and Primary Residence. It talks about the split treatment. It talks about it converting a rental to a primary, which sometimes people like to do that with their vacation property. It tells you about converting a residence to a rental and how that works, and different ways you can use, one or both tax codes. So, again, glad to talk to anyone offline. I don't know if we have any time for questions or not, but I'll wrap it up. And again, I will send you any topics you want to know about, just email me, please.
I think
Thank you.
If nothing else, Lynn, today they have learned that they need an expert in this subject, right?
So review that, like what you need to know about the exchange. Again, you walk into a property, it's a multi-family. Do you live here? Yeah. How long? Okay, well, you have rental units. Do you want to stay invested in real estate, or do you want to pay your taxes? Well, gee, I don't know. You might want to talk to a qualified intermediary before you make that call and learn more about it, because there is a way you could maybe able to save money on taxes if you want to stay invested. That's it.
Good, good. So I did post Lynn's slide deck out to the Slack channel for you guys. So you can download it if you hadn't done it prior to the session, and you can look at your notes. I want to give, I know we're running over on time here. So I just want to give Andrew a quick minute to jump on too, because there's so much stuff going on with the mortgage pieces out there too, before we wrap up. But thank you, Lynn, for everything. We'll make sure everybody has your contact information as well.
Thank you, everyone. And yes, can you refinance after an exchange to pull out some of your equity? Yes, talk to your CPA about when might be a good time. So speak to, is it Andrew that's the mortgage broker?
Yeah, Andrew Marquis.
Ask Andrew if you are going to want to do that when you buy replacement property, how long you need to wait before you can pull your equity out. But can you? Yes, email me for a refinancing template. Okay.
There you go.
Thank you.
Yeah. Thank you, Lynn. We appreciate you.
Bye, everyone.
Thanks,
I've got to run.
Lynn.
I've got to head to Chelmsford for a presentation. Thanks.
Andrew.
Hey, good morning, everyone. Can you hear me okay, Paula?
Yep, we got you.
All right, great. Well, thanks for having me on at the end, and thank you, everyone. I know you guys are going just a hair over the hour. But yeah, I've done exchanges, Lynn. I've done forward exchanges. I've done reverse exchanges. There's a lot of moving parts and a ton of advantages. So what I would recommend is if you have a client with a rental property, they're thinking about selling it or splitting it up, et cetera, I would just reach out to Lynn with the scenario and just have her map out options, because there's so much you can do with that product. And I wanted to kind of dovetail that into one of our loan programs, which is a non-QM program. So this program allows purchasing an investment property with no income verification. And so I had a client last year, when they do a 1031, they have to sell and buy in the same entity. So in other words, if you're selling as an LLC, you have to buy as an LLC. You can't sell as Andrew Marquis and then buy as an LLC, or sell as 123 Main Street LLC and then buy as Andrew Marquis. So with our non-QM program, we can do no income verification on investment properties. We can close with gift funds on investment properties, and we can close in LLCs. So if you guys ever have those questions for a investor client, we have some really great programs for that. As far as like more of a market update, Paula, rates are coming down, guys. Rates are coming down, probably quarter to half a point in the last week. You've seen the stock market kind of stumbling. You've seen the tariffs. You've seen the goofy political stuff that went on this week. So we are seeing interest rates definitely come down, guys. We're locking a lot of loans. March is off to a roaring start after just 3 business days. Tremendous. I mean, I looked at our fundings, and we're going to be up about 33% here in March. So I would just say, if you're not on this train, like, get on it, because it's leaving the station right now, guys. Like, pre-approvals are great. Conversations are great. If you can introduce clients to my team and I, email, phone call, text, whatever's easiest. We've got a ton of programs, guys. Buy first, bridge loans. I had a really nice call with Jack yesterday. We did some joint marketing on a few different scenarios that he was working on. I know we've got some new condo developments coming, Paula. So there is just a ton going on, guys. It's pretty warm out there the last couple of days. So just let us know what we can do to help. If you guys have questions about anything, I just would say the market is really starting to pick up. So questions, Paula? Anything else you had, or?
Yeah, no, the market's actually up 5%, guys, for the beginning of the year. So we want to, like Andrew said, we want to jump on that train. There's activity out there. And I know people seem a little hesitant, but, start to talk about how the interest rates are going down. This is a great time to take advantage of this. We do have some competitive multi-offer situations that I'm hearing about, depending on the property and the price point. Sort of one that won 100,000 over ask yesterday on a $900,000 price point. So that's a 10% over. So the people are out there and they're ready to make the moves.
Yeah, we're doing the fast track credit approvals, guys. So if you guys want pre-commitments for clients, that way when they get an offer accepted, we can issue the commitment letter in as little as a week. We have a Cash Plus program, which is a cash back pre-approval if clients want to waive the mortgage contingency. So strategy calls before offers go in is something that we do all day long. So if we pre-approve a client, you say, Andrew, this place is probably going to get 5, 6 offers. They got to go over asking. I have a great way of explaining to the client that it's not all about price, guys. It's about contingencies. You need to talk to Jack about your home inspection, but I can talk to you about the mortgage contingency. And here's what we can do. We can either do it in a week, that makes your offer a lot better, or we can waive it all together. That makes your offer almost as good as cash. What are the risks? What are you comfortable with? This is going to give you a much better chance at getting your offer accepted. We go over the appraisal. What if it doesn't appraise? What could happen? Do you have extra money? Would you be okay paying a small PMI if you had to? So we go through all those scenarios and just, again, I'd rather work with a client, have them make one offer, get it accepted and close them. I don't want them making 9 offers. I don't want you driving around for 2 months straight. So anything we can do to make your time, more effective is what we're trying to do. So anything
All right.
else?
Any questions for Andrew? All right, we appreciate you guys' time. I'll post the recording for anybody that needs to go back through.